Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Null. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Regular co-host Michelle is off today in her place. We have a returning co-host, a special guest, John Luke Tyner of Aptus Capital Advisors. How you doing, man?
Good, Josh. Thanks for having me back.
Well, excited to have you back. We've got a lot to get to today, do we not?
We do.
Yes, thank you for the outline that we're going to dive into. Listeners, John Luke and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you today. First segment, deep dive on our topic, main topic. Second segment, and here's where we're going to do things a little different. Usually we do news headlines of the week. John Luke prepared, how many slides in that deck?
There's quite a few.
Close
to 50.
Close to 50. He provided a slide deck. And in that slide deck, the first segment, which is going to comprise about the first 20-some slides, we're going to define the issue around the U.S. economy, the global economy, investing. I'm going to give you all a little heads up, listeners. It's going to spook you a little. Is that fair?
Yeah, I think so.
Okay, it's going to spook you a little. However, because we are a glass half full show, we're an optimistic show, the second segment, where normally we do the news headlines of the week, we're going to replace that with the solution. So the overall episode title is going to be The Silent Killer of Your Money. That will make more sense as we dive into our topics. But I do, for those of you all that are listening for the first 20-ish minutes, make sure you stick around for the second segment where we talk about the solution. And then, of course, our third segment, Josh's Crystal Ball and Big Mouth. John Luke and I are both very opinionated people, and we have some predictions. So we'll get to that once we get to the end of the show. Stay tuned for all that. Quick background on me for those of you new to the show. Again, my name is Josh Null. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, grab a pen and pad. We will repeat it several times throughout the show. And then, John Luke, I want to do just a very quick disclaimer, because you and I both have our securities license. Your title with Aptus Capital Advisors is the head of fixed income and portfolio manager. You serve on the Aptus Investment Committee, and you have the CFA designation. Do I have all that accurate?
Correct.
Which is a certified financial analyst, which is a very difficult designation to get.
A few years of my life were spent working through that.
So Aptus, the technical definition, Aptus works with my clients of Gulf Coast Financial Advisors in what's called a sub-advisor role. That's a very simplistic way to describe it. I will tell you that while both our firms are standalone and are both locally owned independently, we have a lot of back and forth, a lot of coordination with our clients' portfolios and investment management. And sub-advisor, again, is too simplistic a term. I extremely value the work that you all do with us. In fact, I just came out of a meeting this week with JD and John Luke with a client we're onboarding, and it couldn't have gone any better. You guys do a great job. But we do have to say, for disclosure, that neither our firms are affiliated, and that you are with a registered investment advisor with Securities and Exchange Commission. You're based in Fairhope. And, of course, Gulf Coast Financial Advisors is registered with the state of Alabama. Both firms are not affiliated, even though we work together a lot. All right, let's get on with the show. Let's get on with this slide deck. So the first thing I got to ask, we're going to set the table. My impression was this slide deck was something that you would be presenting to potential investors, large-scale investors. Tell me the origin of this very detailed and very in-depth slide deck.
Yeah, so to set the stage, when we talk to investors and financial advisors across the country, there's two key things when thinking about investing any money that concerns clients. And the first and foremost is drawdown risk. So that's your money going from $1 million to $500,000. You feel that. It's a smack in the face. It's painful, creates emotional reactions. And so we've built a large part of our practice around managing against drawdown risk. Now, the other is longevity risk, and that's basically you outlive your money or you have to have serious degradation to your lifestyle based on the return of your investments not meeting a certain threshold to allow you to live your best life in retirement like you started off with.
Right.
And so today's focus is really on the longevity portion of financial plans and of clients' investing journey. And basically, longevity risk is the impact of inflation or the debasement of your dollars over your investing horizon. And so, as we all know, the Fed comes out and they talk about a 2% inflation target. Whether we should have any inflation in an economy that is full of innovation and other things is another topic. But you invest in the landscape that you have, not the landscape that you want. And so it's a big part of portfolios. And just to set the stage a little bit on what that means, looking back over the past 50 years, and I think this is powerful. If you had $1 million back in 1972, so a little over 50 years ago, the purchasing power equivalent of that today is about $132,000. So said another way, you've lost about 86% of your purchasing power if you just held that in cash under your mattress and you weren't invested.
Or said another way, to have that same purchasing power today, you'd have to have somewhere around $7 million?
$7.5 million.
$7.5 million. So $7.5 million today's dollars would have the same purchasing power of $1 million basically a couple years before I was born. All right?
Yep, exactly. And so, the cumulative effect of debasement of inflation works in the same way as the compound interest that you hear, Einstein credited with, eighth wonder of the world, having compound interest work for you. And so it's really a silent killer where the purchasing power of your dollar is being diminished. And it's really happened, since we got off of a gold-based standard onto a fiat-based standard. So that's basically where instead of our money being backed by gold, now it's backed by U.S. Treasuries and the military and all of those things. So effectively, the government has a printing press that they can create new dollars in the system. It's been turned on more the past 10 or 15 years than maybe it was back in the day. But the effect is the same. And it's not, again, this isn't necessarily a bad thing. It's just something that you have to take into perspective when you're investing.
Well, so let's talk about that. So a lot of people don't remember or realize that we came off the gold standard in 1971, which I don't want to get too nerdy on this, but basically the dollar was backed by physical gold. At least that was the idea.
Correct.
It probably had gotten a little loose at that point already. But part of that reasoning for that was there still were some scars left from the Great Depression when you can point to some of the reasoning that it took so long for America to recover from the Great Depression was simply the lack of money.
Yes.
Right? And credit. Yeah, credit. And if you look at history, it really was the preparations, the complete pivot of the manufacturing and industrial industry in the United States to prepare for World War II, which involved one of the first times or the biggest times in American history where the government unleashed a torrent of new funds to do this. So consequently, we go to 1971, we come off the gold standard, we have huge inflation, we have basically a president come on when I was a kid, and I don't remember his Treasury Secretary and the Fed, but they tried to break the back of inflation.
Yeah, Volcker.
Right, thank you. And went through this terrible time period where the president wasn't reelected and nobody liked it. Interest rates were super high.
Yep.
In history, with hindsight, you can say, well, they did what they had to do.
Yep.
However, as we all tend to do, there's always an overreaction. So let's talk about the overreaction that started from that time period where at one time you had a fairly tight monetary supply. We weren't printing new money as much every year after year, and we weren't issuing much credit. Well, here come the 80s, baby, and all that goes away. So let's talk about what's happened since then. And as you said in your slideshow, why does that flip been the silent killer of purchasing power?
Yeah, so, back to Paul Volcker and his decisions, very unpopular at the time. I think that was one of the most protested environments that we've seen. People were lining up with pitchforks outside of the Fed's building in D.C. Not popular. The other caveat is that debt to GDP back in that period was about 30%. Today,
explain that real quick.
Yeah, so as far from the debt load of the government was much less than what it is today.
So if GDP was $100, the debt load, our debt was $30.
$30,
right?
Exactly.
Okay. All right.
Yep.
What's
And
it now?
Today, it's about if GDP is $100, it's about $120 to $125.
So we have more debt we carry more debt than we actually produce in gross domestic product
Per year.
Per
yes,
year. Okay.
yes. And so the simple way to put it is it's much easier to raise rates aggressively when debt levels are lower because there's less debt to refinance. In a period like today where there's more debt to refinance becomes a big issue.
What is you may know this off the top of your head after all your research, but the total U.S. government debt load is
36
trillion.
But it's growing quickly.
And it's been growing on average around $2 trillion per year, right? The last handful of years.
Yeah, and even
basically
faster.
since Bush, right? Since the second Bush.
We've been running 2, 3, 4% deficits kind of through the Bush and Obama administration.
Mm-hmm.
There was some austerity pushes after the financial crisis,
right.
which I think really slowed down some of the recovery that we
It
could
did.
have seen,
right?
But what you've seen since COVID is like 6 or 7 or 8% deficits running. So that's you make $100 in income and you spend $107. So you got to fill that $7 threshold with something, and what it's come to is just issuing more treasury bonds.
Right, and that is basically the printing of money.
Yes.
Which works as long as the world continues to buy our debt.
Yep.
I was explaining to my son the other day, I said, son, it's like if Capital One gave you a credit card and they said, hey, you don't really have an upper limit, right? So every year we're going to give you an extra 100% on top of whatever kind of loose limit you have, and you could just keep doing that in perpetuity. I said, well, how long do you think that will last? Who knows, right?
Right.
It all depends on the confidence that Capital One has in you.
Yep.
Well, that's basically the world. In that scenario, the world is Capital One. How long will they keep funding our credit card? Now, you mentioned in 2008, if a person looks like, you mentioned 2008, you mentioned COVID. I was in real estate in 2008, so I can promise you it was terrible. And if you look at the market, it really took about 4-ish, maybe 5 years to start recovering the stock market. But if you look at COVID, it took 32 days for it to bounce back?
Yeah.
Now, why the difference there?
Yeah, so the big difference was the reaction. So, of course, interest rates usually get cut quickly in the backdrop of economic weakness to loosen financial conditions. But what was different about COVID was the checks to consumers that came in the mail, and also businesses that were huge beneficiaries of a lot of the money printing that happened. And so, there was actually some papers written before COVID in 2019 talking about, because interest rates were so low, that the impact for the government in cutting rates wasn't going to be enough to respur the economy during weakness. And lo and behold, they were right.
Right.
And we saw, a huge backdrop of fiscal stimulus pumped into the economy, in addition to monetary stimulus with cutting rates and the Fed's balance sheet, which is basically the Fed has a portfolio of Treasury securities as well as some mortgages that they buy from the market, and the Fed essentially has printed dollars effectively to buy those, and so that's another driver that they're using to loosen financial conditions.
Well, so I want to pivot to bonds because you have a unique perspective on bonds. But before I do that, let's talk about what has been, in broad terms, what has been this never-ending increase in monetary supplies impact on the stock market. Because the regular person walking down the street would say, well, if you're increasing the credit, surely that's doing some damage to the stock market. That's not necessarily true.
Well, a lot of equities and stocks in general are huge beneficiaries of all of the spending because the public sector, the government deficits become private sector surpluses. And so it gets recycled into...
Say that one more time.
Yeah, so public sector deficits, so government deficits become private sector surpluses.
Right.
And so those extra dollars find home somewhere. And so people spend it, especially after COVID, like you mentioned, where, people got their $1,200 or $2,500 checks and they went on Amazon and they bought some crap from China off Amazon.
Right.
And so, it gets spent, and that money becomes earnings for these companies, which is a big part of how we're positioning within our investment philosophy is, the backdrop, it is what it is, but there are ways to get around it. And our thought process is that you have to own more assets that can grow in real terms, so after inflation.
So we're going to talk about that in the solution section. But the problem with that money that you're talking about getting thrown out and buying stuff on Amazon, that money is now worth less.
Yeah.
I mean, even since COVID, I don't know if you have a number off the top of your head, John Luke, I don't mean to put you on the spot, but even since COVID, the purchasing power of $1, it's gone down.
It's down about between 25 and 30%.
And that is just...
in 5 years.
That's incredible. All right. So now, listeners, make sure what we just said. The monetary supply, I don't have the numbers in front of me, John Luke, but I believe JD said one time it's increased on average 8% every year for the last 40 years.
That's correct.
There's 8% more money pumped into the system on average year after year. Not 8% over 40 years, 8% per year.
Yep.
Right. Gosh, whatever compound number that is.
It's like 500%.
Good Lord. All right. Now, which money is like water. It wants to flow somewhere. And typically speaking, if you look at the value of the various stock market indexes, we did a show on the market indexes, and we did it over the last 50 years. It's almost laughable what the S&P was at in 1980. I mean, what's the S&P at right now?
About 6,000.
Yeah, I think, John Luke, I could be wrong, but I think the S&P was 250 in 1980. So money is like water. It goes somewhere. It's flowing into these equity positions. The stock market has, tremendous difference in the valuations compared to 10, 20, 30, 40 years ago. But what's the effect been on bonds? Because in your slide deck, and I don't know if we can put this up, it's probably not for public consumption, but maybe we can get a few of these slides approved through compliance and at least have it on our website for people to look at or on your site, Aptus Capital Advisors. But whereas the monetary supply increase has had an inflationary effect on the stock market valuations, what's it done to bonds?
Yeah. So we have a slide in here that goes back and shows annualized real return for bonds over the past 120 years. So it starts in 1900. And I think what most people would be surprised, and just to define this, the real return of the bond is the nominal yield less the inflation impact.
Put that in English.
Yeah, so the nominal return is what, if you look on treasury.com and you get a 5% yield, right? So that's nominal yield. If inflation is 3%, then your real return is 2.
Very good.
Right? So the real return, after inflation return for bonds from 1900 to 1981 was negative in real terms.
Okay.
And the other big piece too is, remember, interest income is taxed at ordinary income levels. And so after tax and after inflation, not only was your real return negative, but you paid tax on it, probably at a high rate. And so you went through an 80-year stretch where bonds were a negative real returning vehicle. Now we had that stretch that you highlighted after Mr. Volcker took rates to 20%, right? We went from 20 to 0, right, between 1980 and COVID, where rates basically went, in a straight line down, where bonds were positive on a real return basis. And then you had 2022, which was brutal for really all investors.
In the bond market, so the stock market, the S&P was down around 18% in 2022, but the bond market, overall bond market was down
about 15.
Gosh. And because we have been told all of our investing lives that stocks and bonds are not correlated.
Correct.
Some even argued that they were inverse relationship. 2022 proved that false. Fair?
Yeah, very fair. And the next slide in our deck really hits on that. So, just to put it in a conceptual picture of kind of a race car, I guess. Like if you think about your race car, your stocks were your engine of your car, and your bonds were your brake through that period where interest rates
So your
were dropping.
brake lines blew everywhere.
The brake lines are gone.
You're gone.
And so what you've seen is that correlation between stocks and bonds the last 5 years has flipped very positive. So that means when stocks are up, bonds are up, but when stocks are down, bonds have been down as well. And that's problematic for your typical, 60% stock portfolio, 40% bond portfolio when they're not yinging and yanging like you want them to.
That's a great point. I want to talk on this more. So you have fixed income experience. You're the head of fixed income for Aptus Capital Advisors.
I'm probably the least bullish fixed income guy out there.
And listeners, the fixed income is a fancy way of saying bonds.
Correct.
Easy way to translate it. So you are, in theory, if the listener's listening, you're saying bonds not great. But let me be more specific. Historically, people have said when I want to just have safe investments, and what that meant was bonds or treasury bills or bank CDs or money market funds. What you're telling me and what you're telling the listeners is that the concept of bonds as a safe money investment is maybe not an entirely accurate portrayal. Is that true?
Yes, and I think the I guess counter to that is that at least nominal rates are higher,
right.
So you are getting paid something on your money, whereas back 5 years ago you weren't at all. In many places across the world, rates were negative.
I didn't even talk
insane.
About money market funds 2 years ago.
Yeah.
I mean, it was an irrelevant conversation.
Right,
Yeah.
and the nice part about yields being higher is, for the client that's 80 years old and they need to fund X amount of living expenses, then sure, they can park a portion of their money in bonds, get some interest on it, and pull from that. But I think the key of that is you have like a bucket one setup, which is basically your cash. Mm-hmm. That allows you to be more aggressive with the rest of your money, right? To have that invested in things that can grow.
Right. Yeah. So in other words, we're not saying bonds are bad across the board. What we're saying is there's more to the story. And when we get into our next segment here in a couple minutes, we're going to talk about the solution around how do you counter this problem where the 60-40, like John Luke mentioned, the traditional 60-40 portfolio, 60% equities, i.e. ETFs, stocks, and mutual funds, 40% fixed income, i.e. bonds. That portfolio is basically what you've done is you're participating in 60% of the potential market run-up, but you think that you're counterbalancing that with a certain steady eddy on your 40%. And basically what you're doing is you're just sitting there trading water on that side. That's how your
you're
portfolio.
Racing a Honda Civic instead of the, whatever the engine that they're running in NASCAR or F1.
As JD says, you're driving a four-cylinder Camry, which I immediately picked up on. That was what car he had, and I was right. Because you don't reference a car. I would say my Mazda 626 with my little four-cylinder that took 2 quarts of oil for every tank of gas. Thanks, Dad. All right. So as we're wrapping up this segment, then let's talk about this. We both agree, and I think anybody listening agrees that America has a debt problem, right?
Yep.
It's only a problem when the rest of the world quits buying our debt. So let's make sure we're clear there. As long as the Capital One scenario plays out where everybody just keeps increasing our credit card limit, so be it. We'll figure out a way because we don't have time in this show. But there is an argument that, especially in especially in recessionary periods, running a deficit can actually help the economy recover quicker.
Yes.
Right. On the flip side of that, I think everybody knows that while everybody knows that we need to fix the problem, there is such disagreement on how to fix the problem. So in your slide deck, you've got solutions to the debt problem. We want to tread carefully politically, but let's talk about some of the ways to do this.
Yeah, so when you have a debt problem, there are 3 predominant ways that have been used historically, right? The nice thing is this isn't something new, nothing new under the sun, right? We've seen...
It's just bigger numbers than we've ever seen.
Bigger numbers, right?
Right.
And so the backdrop of getting out of the debt problem is threefold. is some sort of austerity. So that's the government slows down the spending.
Good luck with that.
They raise taxes,
Right.
Doge, or heaven forbid, default, which you see the default trigger pulled from emerging markets.
Right.
You don't see that from the U.S. government. And the
Right.
benefit we have is the reserve currency of the world. We're not going to default on the debt. We're just going to pay it back with dollars that are worth less.
We're going to intentionally debase the value of the dollar.
Exactly.
Right.
So that's number one and probably out of the fold, right? And the second piece is if you raise taxes too much to fill that void, then people leave. You've
Right.
seen that in UK, you've seen that in Norway. Like taxing the wealthy to an overextent doesn't work.
Well, you saw in the 1970s where the highest marginal tax rate in the United States was 90%. Now, that doesn't mean you paid 90% on all of your money, but for those of folks that were making a certain level of income, a high income, there was a part of their income where they were getting 10 cents on the dollar.
Yep.
There's no one you're going to have so much shenanigans to avoid that.
Yep.
It's counterproductive. Sorry, keep going.
Yeah, great point. And the other two are really the solution that we think probably plays out. And so that's the inflation and debasement, where you make your dollars worth less and less over time. So you pay back the dollar, pay back the debt in the future with dollars that are worth much less. So it eases the debt burden. Now the third and probably the most exciting and one that we've heard a lot about the last couple of years is growth and productivity. And so think AI, think advancements in technology. And so the hope is that you get some combination of the two, and where the inflation is maybe higher than the Fed's target, but it's tolerable.
Mm-hmm.
The last 50 years, inflation's averaged 3.6%.
Mm-hmm.
Target's 2. So we're over target, but it hasn't been devastating, right? But if you can grow and have productivity increases, then that's the other key solution to get out of this problem.
Grow your way out of the problem. All right, very good. So we've defined the problem. Listeners, if you're interested in continuing this conversation, now again, we just did the not totally negative, but we defined the issue, right? The silent killer of your money. I want you listeners to hang tight, come through the break on segment 2, because we're going to talk about solutions. Now, as John Luke and I agreed upon, we're not going to try to solve the world with this one episode. We're not even going to try to solve the government. What we're going to be talking about is what can investors do to overcome this challenge to their portfolios. Fair enough?
Fair.
Okay. So, folks, before then, if you want to reach out to us, you can give us a call, 251-327-2124, or go to our website, Gulf Coast, FA is in financialadvisor.com. On the site, there's a blue button, upper right-hand corner. Click it. That can put something on my calendar. It could be as simple as a 15-minute introductory phone call, a 30-minute video meeting, Zoom, Google Meets, whatever you want. Or, my preference, you can schedule a 1-hour in-person meeting, any of our 3 offices. We have offices downtown Fairhope. We have one office in Orange Beach. It's just down the road from the wharf. And we have an office in Mobile. It's off Dolphin Street and I-65. However you reached out to us, make sure you do it. We'd love to meet you. All right, folks, coming up next, segment 2, we define the issue. We had the silent killer of your money. Well, how do we get in front of this hacking blade coming for our throats, John Luke? That's what we're going to talk about in segment 2. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Null here. So, as we discussed in segment 1, we outlined the issues around your money. We talked about the silent killer of your money. If you missed that and you're just tuning in, Do note that we put this show up on our website the days after it airs on FM Talk 106.5 and WHEP 92.5. So you can always check out the episode and see what you missed in segment 1, the silent killer of your money. But for those of you that were listening, you thought, well, everything sounds like we've got, at the very least, we got a real struggle. In fact, some people are probably listening to this and saying, well, we're screwed. Listeners, you're not screwed. And so for this segment, we're going to talk about the solution or some potential solutions, because we always want to preface this, John Luke, as you very well know, all investing involves risk. We're going to be talking about an investment philosophy that definitely skews more towards equities, i.e. individual stocks and ETFs. And, some people are just not comfortable with that ride. You don't know if you heard the episode, but a couple episodes ago, Michelle and I talked about roller coasters. I can't stand roller coasters. It's not so much the up and down per se. It's just I don't trust people to build things mechanically that could kill me if they go wrong. So airplanes and roller coasters, I'm kind of out. But we made the analogy, and you tell me if you agree with this or not, then I'll kick this conversation off to you. But we talked about what we're going to dive into more around hedging. I said, what if a roller coaster ride costs $10, but I could pay an extra $1 to the guy selling the ticket, and in exchange, maybe I don't go quite to the very top. I get 1 or 2 feet off the very top. But more importantly, I get 7 to 10 feet off the bottom, so my stomach's not going through my shoes. And would I be willing to pay that? You bet your life I would.
Yeah.
So let's use that as a kicking off point. We talked about monetary supply. We talked about debt loads. We talked about all these issues facing investors in the first segment. What are some ways, as we move further down your slide deck, to accommodate, especially with asset allocation, what can investors do around the issue we defined in segment 1?
Yeah, exactly. So the way out, we think, again, is to grow the economy faster than the debt grows, right? So that's running nominal growth, which includes inflation at a higher level than the debt load. So when you think about, what that means for portfolios, and I love the analogy with the roller coaster.
Is that good?
Yeah, it is
okay, good. I was hoping
good.
JD wouldn't call me and tell me I was an idiot. So thank you.
Yeah. I mean, you're lowering the volatility of your profile, which is, I think, a key solution to what we're trying to do within the investment portfolios. So it comes back to how can I own more equity exposure, which has the ability to grow earnings at a real return, so after inflation, at a number that's large enough to help you fulfill your financial plans, right? Because inflation eats into your financial plan into the future, and it's compounding against you. So you got to grow faster than that. So our philosophy is, how can we help investors own more stocks and less bonds in their portfolios, but do it in a way that's risk neutral? And again, to get back to kind of thinking about how returns are generated, if I think about a bond, I have no growth on that bond. Uncle Sam doesn't, you buy it for $100, Uncle Sam doesn't give you $102
Explain that real quick. So you buy a bond for $100 par value.
Par value.
Right. And so as opposed to a stock, I always, for the listeners, if you want to own a piece of Apple, you buy an Apple stock. If you want to loan Apple money in exchange for an interest rate or yield, you buy an Apple bond. But that the stock, as any Apple owners will know, has gone up significantly in value over the years. If you have an Apple bond, it may fluctuate some with interest rates, but it's not going to have the compounded growth of the potential upside that you would with a stock. Don't mean to interrupt you, sorry, but I want to explain that real quick.
Perfect. I mean, you buy it for $100, the Apple bond for $100 for just a hypothetical example, and you get 4% interest. So just say it's a 5-year bond. I give $100 today to Apple. I get $4 in interest for the next 5 years, and at the end of the 5 years, hopefully you get your 100 back, right? Mm-hmm. If I own the Apple stock, I get the dividend instead of the interest,
which is the profit of the company,
right? Which is the profit of the company that they distribute out, right? Plus, I get the growth of Apple, so their earnings, they buy back shares, they make acquisitions, they improve their margins. I get to appreciate the ride of Apple, being a well-run company. And so when we think about returns, you have to really break it down into those two components. Bonds don't grow, and they pay you a yield. Stocks grow, hopefully, and they pay you a dividend. At least some of them do. And so when you think about your long-term growth, it's the combination of those two, right? So if my bond has 0 growth plus 4% yield, I got a 4% return. if you look back at the long-term average for the S&P 500, say the last 50 or 50 plus years, it's paid an average dividend of about 3.1%, while it's had growth of 5.2%. So, you're over an 8% compounded return, yield plus growth.
Very good. That's a perfect way to put it. All right, I got two things. Savvy listeners are saying, hey, guys, you just told me that the bonds don't change much in value, but in the first segment, you said that bonds were down 15% in 2022. I'm going to explain it in my rudimentary terms, and then I want to ask you a question. So if I buy a bond that's paying, you said 5%. Let's say I buy a bond that's paying 3% for $100, and it's five-year duration, and the interest rates rise. The Fed decides to raise interest rates because they're battling inflation. Now, another investor could go out and buy that same $100 bond at a 5% interest over 5 years. If I want to get out of my 3% bond and get into the 5% bond, I'm going to have to discount that bond.
Yes.
And so what we saw, now that's a fairly calm example. What we saw in 2022 is you had bonds at 1-ish%, and now you had bond offerings in the 5, 6, 7.
Yep.
Now you're talking extreme discounting, consequently your 15% reduction. So my question to you would be, and I think I know the answer, but what happens if we have a rapidly decreasing interest rate? Are we still going to get that 15% upside on the bond? We don't, correct?
Well, the price of the bond would go up, just like your example of if I locked in that rate and rates moved lower. But the key ingredient there is that rates have to move lower. And the question is can rates move lower with inflation higher, with the fact that we have to run nominal GDP growth at a higher rate? And our thought is probably not. And your 15% was kind of a best case. That was like your aggregate bond index.
Right.
Your longer duration bonds, so think like 15, 20, 30-year treasuries, was down like 30, 40, 50%.
Right. Well, and folks, too, generally speaking, interest rates are rapidly reduced in times of recession when you're trying to increase the flow of money and credit, right? Right. So it's not, even though it sounds great, the interest rates are going down, a lot of times it's in response to something.
Right.
What we had was a little bit of a sugar high for many years where even though the economy was doing fine, they still kept rates low.
And I would say, too, if you think about, in 2020 or 2019 when rates were super low, what's your biggest regret today knowing what happened, right? It's not that you didn't, you should have bought a house for a few more $100,000. You should have borrowed more money. And so that mentality has now ingrained in consumers. And I think that, the Fed knows that, the market knows that. So if they slash rates to zero again, you probably risk an even greater inflation cycle than what we saw the last couple of years.
Right. That's why they're being so cautious. I know it's become a little bit of a political issue, but you and I both have economics backing. There's a science and a math to what they're doing. Now, I want to pivot to, this was again from the meeting that we had with a client with JD, and he said something I found just really, really interesting and fascinating, and I'm assuming it's been spurred by your some information in your PowerPoint. He said that a lot of times investors focus on the asset manager or the fund for their potential upside or their performance outcome or anything like that. He said that the most important component was the asset allocation. Let's talk about that. What does that mean?
Yeah, so asset allocation is basically your breakdown of, do I allocate X amount to stocks and Y amount to bonds? And security selection is, do I pick this fund manager over that fund manager, or do I pick small cap over large cap, things to that extent. And what you've seen long term, Vanguard did a great study on this, and they found that about 91% of your long-term success is defined by your asset allocation decisions. So that's how much stocks you own versus how much bonds you own. Only 9% of your performance came from picking, the manager. And what you see today, and we see in many of our conversations with advisors and clients, is they're so focused on picking the right manager versus fixing their asset allocation that they're overlooking a huge part of what matters.
Yeah, JD said that you could have the best fund manager on earth, but if their asset allocation was out of whack, it wouldn't matter.
Yeah, very true.
All right, very good. All right, so let's start bringing this together to a real world solution. So let's summarize what we've talked about so far. Everyone is in agreement that we have, I mean, obviously it's a known quantity that we run deficits and we continue to run deficits, and even to the fact that the current budget bill being debated right now will increase the deficit.
Yep.
Right? Even if you are politically to one direction, you know that, and don't agree with the number they're throwing out there, I don't think anybody's disagreeing that it will increase the deficit, which means that as far as we can tell, we're going to be on the same path of increased monetary supply. We're going to be on the same path of your purchasing power of your dollar being decreased. And folks, I hate to tell you this, but that's called intentional debasement. That's not an accident. Like John Luke mentioned earlier, there are certain ways that governments manage their debt load and their debt commitments, and this is absolutely one of the tools in the toolbox. We've got money flowing into the stock market. I mean, there's a lot of economic data out there, especially man on the street, Main Street, that doesn't feel great. Yet the stock market's doing fine, right?
Yep.
So that should tell you something. And we have a proven track record, particularly 2022, that bonds, while having an absolute solid purpose in investing portfolios, having meaning, we're not saying bonds are bad. However, the story that bonds have been telling hasn't been 100% accurate. Does that kind of sum up what we've come to?
Yeah, and debasement can work for you too. Think about if you would have gotten a 2 or 3% mortgage on your home the last several years, right?
Yeah.
Your mortgage payment stays the same.
Right.
Your income hopefully goes up,
Yes.
right? So you're paying back that mortgage with inflated dollars, and so it also can work for you to some degree.
So let's wrap up this segment, John Luke. I do want to get in the weeds a little bit because you all talk about doing better in the tails. So the core of the portfolio, I tell folks when they come on board with Gulf Coast Financial Advisors, and again, for those of y'all that are unclear in our relationship, you all work with me on the investment management with our clients, with the portfolio construction, with the trading. It's a continual, we don't talk over the phone all day long, but we have tools and where we talk all day long, back and forth. It's a great relationship. But I tell them, you're going to look in this and you're not going to see any magic or any voodoo. This is pretty solid stuff.
Yep.
So the core of the portfolio is, hey, we're going to try to get these holdings that we think got great upside potential. We're going to lean towards the equity side. We're trying to keep your costs down, and we're going to keep moving forward. Well, anybody can tell that story. Let's talk about how you all handle the tails that make it different when a client of mine, Gulf Coast Financial Advisors, is working with our team, including Aptus Capital Advisors. Is that a good setup?
Yep. So when you think about market dynamics, we segment it into really 3 buckets. You have bucket 1, which is your right tail move in markets. So that's markets moving drastically higher. So think like your S&P's up 10 or 15% or greater. That's a right tail. The bucket 2 is the middle tail, which is the average return for the S&P is 8-ish%, which has rarely actually happened in terms of actual number.
It dances around that number.
Right. So that's your underneath the bell curve type of situation. So everything's kind of good in that environment. And then bucket 3 is the dreaded left tail. So that's when the market really draws down. Now you don't see that happen extremely frequently, but the magnitude of those moves are drastic. And to put some numbers into that, what we've done is a study on the contribution to long-term returns of equity markets. And what we've found is how returns are dictated over a longer period is really defined by the tail environments. So that's, did you participate when markets were rising, or did you fall as much when markets were really nasty? So about 2/3 of your performance is defined by how well you do in those 2 tail environments. And what's a crazy stat is since 1950, you've had almost 30% of market years where the S&P 500 has been up over 20%, right? And most people don't realize that,
no,
right?
They do
the
not.
average return is 8.
Yeah, because good news doesn't sell. Keep going.
So when you think about building a portfolio, the better you can participate when markets give you those right tail environments, the better your long-term outcomes. If you can protect against not drawing down, in the bad years. And the simple illustration there is, I'm a golfer. Golf is 18 holes. It's mentally very challenging. There's a lot of different things that are thrown at you through that period. It's a very similar analogy to investing, right? Year in, year out. Well, I can play 17 beautiful holes on the golf course and have one hole that I make a 10 on, and it derails my entire journey. And so it's the same thing as investing. You can have great returns for 8 out of the 10 years, but if you have really nasty returns on 2 of those holes or 2 of those years, you're potentially putting a big hammer in your compounding journey.
So in this segment, what if you could pay an extra fee, a sunk cost for those 2 holes to where it automatically reduced your amount of swings?
Yeah.
Is that a decent definition of hedging?
Yeah, if you could take a bogey instead of a triple bogey.
There you go. Listeners, I know we got your attention now. If you're interested in continuing this conversation, we encourage you, give us a call, 251-327-2124. Go to the website, Gulf Coast FA is in financialadvisor.com. Again, upper right-hand corner, you can put something on my calendar, phone call, video, Zoom, or in person, which I prefer. All right, folks, coming up next, we've got a very short segment, Josh's Crystal Ball and Big Mouth, what's been some of my predictions. Actually, this time I'm going to turn it over to John Luke, and we're going to get a big prediction out of you. Is that fair?
Sure.
Okay. All right, so stay tuned. We'll be right back. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Welcome back. Your host, Josh Null, here, alongside guest co-host John Luke Tyner of Aptus Capital Advisors. All right, so John Luke, you've known me long enough to know that I'm fairly opinionated, right? You know what's funny? Michelle will tell you this. I'm not shy, but I can be a little self-conscious. So we'll get out every now and then, and Jay gets it more in Mobile, but people will recognize from the radio show the name, and it sounds like oh my gosh, I can't believe I'm going down this road. But they'll expect you to be kind of like you are now on a microphone, and I'm not. Maybe get a couple pops in me, but normally I'm relatively quiet guy.
You're in your element here.
I'm in my element. I love this stuff. Jay gets it way more over in Mobile than I do. They come up. He's signing autographs at this point. But we do this little segment. We have some fun with it. I am opinionated. I like to make predictions. I'm very skeptical of my own industry, which you admitted earlier. Here you are in fixed income, but you can be skeptical. So you and I have a similar outfit point there. But let's talk about, you had something when we were doing show prep. You had a nice prediction to make. I felt like it was a positive one. I didn't write it down. But tell me what you had to say positive. Where are we heading with all of this? What if you had to sum it up for investors? Hey, we're like, a lot of times they'll turn on the TV and they'll say, you guys are screwed, buy gold. Are we telling them that, or what are we telling them?
Yeah, no, not at all. To put it in simple terms, as investors, you either own risk assets that can grow and inflate with the monetary problem and debasement that's happening over time, or you can own the currency, i.e. the bonds that are getting debased. There's no real middle ground. And so when you look at the construction of portfolios, we think it's as important as it's ever been to have the correct asset allocation within your portfolio to be able to fight this backdrop. And you can turn on the news and you can get a lot of negative things that people can say, but the reality is, if we go through a period where the monetary supply grows at above rates than maybe it should, as long as you own stuff that can keep up, then you're not digging a hole, dig in your own grave. And so when we're building portfolios, we're just really trying to help investors prepare for the backdrop that we face.
And do you think part of that conversation is reevaluation of their actual risk tolerance? Do you think that's important?
Well, yeah, and I think that most people's risk tolerance, or at least horizon for investing, is much longer than what they realize. And so you getting tied into the negatives on a day-to-day basis and overly watching your account probably brings too much stress than what you really need. You have to focus on the long-term planning and goals, and that's why you're having conversations with Josh to help you build those financial plans. But ultimately, your investing horizon is much longer, and a lot of it's legacy. And really, you asked the question at the beginning. I built this slide deck because we had a few different clients that liquidated their businesses for large sums of money, and they were able to look at their investment options and say, "Hey, this 4% T-bill sounds pretty good." But when you put it in perspective of the debasement to their legacy in the future, that most of the guys were working at these companies since they were 14 years old. They saw it go from nothing to something large. They liquidated, they got the payment today, and now they're forced to invest it. And what we really tried to do was open their eyes up to the impact of their dollar, the debasement of their dollar long term, and what they could quickly realize is, hey, going the safe, certain route and long-term uncertain route was maybe not the best option. And so we opened a lot of eyes from that perspective.
That's great. I don't mean to put you in a corner, but will this be publicly available on Aptus Capital Advisors?
So we have a blog that we put out that folks can have access to through our website.
So folks, I'll put the link to that in the show transcript. Again, you can find that on our website, gulfcoastfa.com, podcast tab. You can find a link to the information we've been discussing today. Well, John Luke, man, that was fantastic, dude.
Yeah,
did a great job.
Thanks, Josh. This was fun.
Yeah, I'm finally catching up with you. I don't know if you noticed, I've done my homework.
Yeah, no, you did great.
Thank you. I appreciate that. All right, folks, we invite you one last time. Give us a call, 251-327-2124, or go to our website, gulfcoastfa.com. Blue button, upper right-hand corner. That will put something on my calendar. Again, we can do phone calls or Zooms, but I prefer in person. Let's meet. Downtown Fairhope, Orange Beach off Canal Road, or Mobile near the intersection of Dolphin Street and I-65. However you want to do it, just give us a call. Folks, that is it this week for Coasting Retirement. I want to give a huge thank you again to my guest co-host, John Luke Tyner. Did a great job, buddy.
Thanks, Josh.
All right.
It was fun.
Thank you to our show sponsor, Jay's Business. That's Providence Partner Jay Stubbs, Providence Partners. If you meet him out in Mobile asking for an autograph. Thank you to our two radio stations. That's FM Talk 106.5 out of Mobile and WHEP 92.5 FM in Foley. Many thanks to the provider of our show music, that is local band Sloth Racer. Huge thank you to the show producer, that's my son Peyton Null. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting and Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.